All right. Joining me is Garrett Paolella, co-founder and managing partner at NEOS Investments, who's a unique ETF issuer, currently offering 10 ETFs, about $5 billion in assets. That includes an ETF we're going to discuss this week that is crypto related, the NEOS Bitcoin High Income ETF, ticker symbol BTCI. Garrett, great to connect, and thank you for joining me.
Yeah, Nate, thanks for having me on today. Looking forward to today's discussion.
I'm glad you're here because one of my goals with Crypto Prime is to just help educate the crypto community on what's happening on the TradFi side of the equation. It's not just educating TradFi on crypto. I'm really trying to cover this entire intersection of crypto and traditional finance. And as I mentioned, you do offer a Bitcoin related product, the NEOS Bitcoin High Income ETF. This just launched last October. And there's a number of different avenues I want to explore here, but let's just jump right in to start. Just tell us high level about this ETF.
Sure. So the NEOS Bitcoin High Income ETF, BTCI, is really focused on giving clients exposure to the Bitcoin, but looking to do so on generating a high amount of monthly income by harnessing the volatility of Bitcoin. So this product is going to generally lower your overall volatility relating to owning a Bitcoin, but also really produce a high monthly income that's targeting roughly 25 to 30% per year of distributable income from the product.
And this is utilizing something called a covered call strategy. Can you talk about that in a little more detail, exactly what that is?
Yeah, that's correct. So a covered call strategy has actually been around for decades, and institutions and advisors have been using them on traditional financial investments as a means to generate income, lower volatility outside of just the long exposure. And so as we think about that for BTCI, we're going to be long exposure to Bitcoin, and then we're looking to leverage the covered call nature, meaning selling a short call to generate income. And what you really get out of a covered call strategy outside of lowering the volatility and generating income, that trade-off is really giving up some level of your upside in order to generate that current income. And so we try to sell away maybe just that very tail end of that upside so that you have a good total return, but you're really using the asset class as a way to, generate income for your portfolio.
One of the narratives that's out there, which I think is accurate, though this is coming down a little bit, is just the volatility of Bitcoin itself. And I'd love to have you elaborate on why a high volatility asset such as Bitcoin can actually pair really nicely with a cover call strategy. Do you want to explain why that is?
Yeah, I would love to. So, the higher the amount of volatility in an index means there's more risk associated with it. And so, risk transference, when you're thinking about using options, is really looking at volatility and what the expected return is going to be. And so, ultimately, the higher the volatility, the higher potential risk associated with that asset class. And so, when you're selling an option, right, you're selling that risk, you get paid more to take on that risk. And so the higher the volatility index, the higher the amount of income that can be generated for that underlying covered call strategy. And so I think the quick reference to just give a sense of Bitcoin volatility relative to maybe the S&P 500 is the S&P 500 volatility sitting around 16, 17 today. And Bitcoin historically for, say, the last 12 months or so is averaging more about 60, right? So you're getting a significantly more amount of volatility in that underlying index for Bitcoin that you are than maybe the S&P 500.
By the way, I should have noted at the top, you are obviously a portfolio manager on this ETF. Before we continue just with what the ETF itself does, tell us a little bit more about your background.
Sure. Would love to, Nate. So my background has really focused on option-based investing since, I would say, early 2008. I used to work covering a lot of hedge funds, mutual fund companies, and my co-founding partner here at NEOS, we really pioneered bringing option-based strategies into ETFs way back into 2013. And so we brought some of the very first products out, but my core belief has always been ways to generate tax efficient monthly income and using options and ways to help investors aid their income generation in their portfolio in tax efficient ways, whether that had been big institutions and hedge funds, or for really now the last 13 or so years, helping advisors find different ways to augment their portfolio using these option overlay strategies, in an ETF format, because we love ETFs. They're the most liquid, transparent, cost efficient. But there's also ways that you can manage an option strategy on even a more tax efficient basis using that ETF structure. So really spent my career managing these types of strategies and pioneering the ETF space.
Well, I'll tell you, you're certainly sitting in the right place with the explosion of options-based ETF strategies that we've seen. And actually, I want to ask you about that a little bit later, just as it pertains to options-based crypto ETFs. But digging in a bit deeper with BTCI, what actually happens inside the fund if the price of the Bitcoin index exceeds the call strike price at the time of expiration? I'd love to have you just explain, like, what is actually happening here? What does that look like?
Sure. So we're getting exposure to that Bitcoin. So the underlying Bitcoin position that we hold within the fund is going to appreciate in value the same that Bitcoin will. But when you start adding a covered call strategy, there's a couple of factors. But in general, the covered call strategy, as you exceed the strike price, is going to cap the part of the participation you would have to Bitcoin. So let's take a really simple example, because our fund specifically has multiple different factors to try to manage the income generation, but also the upside capture, because that's a very important part. But generally speaking, is if Bitcoin, is at 100,000 and you wrote a covered call option that's at maybe 110,000, you would get all the price appreciation and growth to that $110,000 level. But anything above 110,000, you would not participate because you've sold that call option in order to generate the income. If the price of Bitcoin stays at or below that 110,000, you've earned that income somebody paid you to essentially sell that option to you. So you would be capping your upside based on how much of the portfolio you've written options against and also where those options are positioned.
And just to round this out, talk about the downside. So let's say Bitcoin is down significantly. What happens?
Yep. So Bitcoin's down significantly. That amount of income you got paid to sell that call option would be that buffer or downside protection to your participation in Bitcoin. So again, if it went down to, let's say, 98,000 and you were paid 2% for that option, you would still be at that $100,000 return level. And so you would have outperformed Bitcoin by the amount of income you generated in that scenario, 2%.
By the way, do I have it correctly that you were the first Bitcoin ETF to utilize Bitcoin index options?
So we are the first one to use the Bitcoin index options, although our fund is structured to be able to take advantage of other types of options like on IBIT or BITO or other futures or spot, ETPs as well. So we have flexibility, but from a firm standpoint, we do try to use index options wherever we can for a lot of their benefits, we feel like, over other type of option structures.
And you gave us a couple of examples, but just in general, how far out of the money are you writing these calls? What's a typical time horizon, the time till expiration? What does that look like?
Sure. So we like to set our positions up on more of a monthly roll. So we're executing our trades and our options close to the end of the month because we want to help investors understand how to relate that back to their month-end performance statements. But we're writing options that generally are 6 to 7 weeks in duration, and those are going out to like the next full options expiration. But when we're thinking about generally like our factors and the way we look at things is we want to meet a specific income target for clients. So for this product in BTCI, it's really looking at generating that 25 to 30% income level. So we look at a couple of different things, which is that out of the moneyness of where we're writing those options, that can average easily 10 to 20% on a monthly basis, right? Volatility is so high in Bitcoin that we can write options that have a really far out of the money structure in order to participate in the upside. We also ladder our options. We don't just write one. We write, several options, at least two or more, in order to diversify that strike risk of where Bitcoin might appreciate to over that month period. And then once we've assessed really where the options need to be positioned to generate our income level, we won't write on the whole portfolio. So as an example, last month, I believe we wrote on options that were roughly 12.5% and around 20% out, and only on half of the fund. Because volatility, again, is so high, you don't need to write on that whole portfolio to generate that income level.
I'm looking at the holdings here, and it's interesting. I noticed that you're holding the VanEck Bitcoin ETF, ticker HODL, HODL, which what a great ticker. But just out of curiosity, why that one out of the 11 or 12 spot Bitcoin ETFs that are out there?
Sure. So that one still just doesn't have any fee associated to it. So they've allowed it to be at a zero cost. If the ETP that we would use as some of our exposure were to have a fee, we always in our products will cover that fee out of our expenses. So for now, HODL has, obviously a low cost structure to it, in a passive spot Bitcoin, just like all the rest of them. And, if that came with a fee, then we're always looking for, low cost exposure into the spot ETPs.
And talk more about what the distribution rate on this ETF has been thus far. And also, Garrett, I don't want to get too far into the weeds, and you're certainly not here to offer any sort of tax advice. I want to be crystal clear on that. But can you at least touch on how these distributions are taxed?
Sure. So the income that we're looking to distribute on an annualized basis is going to range roughly in that 25 to 30%. As a firm here, we always look to leverage what volatility and the income we can generate off the portfolio, but we do need to be cognizant always of the total return. I don't think all products look at that, but for us, making sure that the total return supports a distribution rate is essential. And so we feel that 25 to 30% is a good middle ground to getting that income generation off that high volatility, but being able to capture, still a significant amount of a move in obviously an asset class that can, as we've seen, go up 20, 30, 40% in 1 month. As we think about taxes, that's a big component of NEOS overall. NEOS really focuses on tax efficient investing. And so that looks different in different products. But at the core is for BTCI, the options we're using, index options, don't currently get the 1256 tax treatment that sometimes are referred to in some of our other products. That might change in the future. I know there's a lot of conversations around that from more of a regulatory standpoint, of course, way above our decision and pay grade. But right now, those will get an ordinary income allocation. But one thing we do that's much different is we always integrate a tax loss harvesting structure in all of our products. And so something we like to do is when you can generate a loss in the portfolio, we would like to capture those losses, right, and roll into another option structure. And so what ends up happening, which is also a benefit of the ETF structure, is that if you generate a loss, you can carry any of those losses forward indefinitely. And so at the end of the day, what does that really mean is if we're going to go distribute you roughly 2% in the fund, but we have a historical loss that offsets that 2%, it recategorizes a positive return into a return of capital from a tax designation standpoint. And so when it's taxed as a return of capital, it's not taxable in the current year. And so that investor takes the whole 2%. However, it will reduce your cost basis in the fund and really defer it into a long-term capital gain. So what we like to do is the simple way to think about it is if given the opportunity to convert ordinary income, short-term capital gains, or even long-term capital gains into a return of capital, that reclassifies the income and distribution all to long-term capital gains for the benefit of the investor.
How has this strategy compared to actually holding Bitcoin itself? And again, I know your ETF has only been on the market for 3 or 4 months, but I'm assuming you have some historical data here. What can you tell us about how your strategy has compared to the actual price return of Bitcoin?
Yeah, that's correct. So when we saw the big rally coming from kind of mid-October when we launched the product through the election, and obviously seeing a very pro-crypto friendly administration coming in, we captured roughly, I'd say 70 to 75% of that upside move. But since Bitcoin has more moderated, we've captured more because you've started to see that sideways market. So I would say like our general goal for the product is to capture kind of anywhere from 75% or greater to the upside move, but where any covered call product would deviate from that underlying is in those really significant short-term, bull runs that you could see across any asset class. So where this product, I would say, fits relative to comparing to just spot Bitcoin is you'll get that lower volatility. You're going to get that monthly income in those really big tail moves where you see, Bitcoin rally significantly in a short period of time. We won't capture all of that, but you will outperform in a flat or down market as well. So over time, that kind of moderates to really, targeting I would say a 75% or greater upside capture in this type of asset class where, you see obviously a bull case for it and significant, short-term, upward moves.
And what about the strategy just in the context of a broader portfolio? So you just mentioned comparing to spot Bitcoin ETFs, for example, but let's put those aside and let's assume that you have a traditional 60-40 investor or maybe somebody that has a small sleeve to alts. Just where does a strategy like this fit in the context of a portfolio like that?
So I think that's a really good question. We're actually having a lot of conversations with traditional financial advisors, investors that have been in the core asset allocations, and so we've seen a couple things. One, just as a portfolio enhancer for participating in crypto that their clients are asking for. So they're hearing that they want exposure, they don't want to necessarily buy it through a crypto platform. They have to open up a hot wallet, a cold wallet, understand all the ins and the outs of actual digital assets. And so we're just seeing that as an allocation, broadly speaking. Some advisors we've seen bucketed into alternatives. So whether they're taking a stance on some type of either long short or private investment, this is another way that they're essentially adding a more high octane allocation to their portfolio. I think most investors generally are viewing Bitcoin and crypto as that higher octane. I'll take the risk, I'll take the reward. We think long term, this is going to go up in value, whether you wanted it at 50,000, 80,000, 100,000. And so we're just kind of seeing them as broader diversification of portfolio investments for more that growth oriented area. But now us launching a product that focuses a lot on income, we're finding a lot of advisors feeling a little bit more comfortable to pull the trigger now than maybe they had been thinking that they might have missed just a pure long only risk exposure to Bitcoin. This gives them something with a little volatility reduction, and certainly income that if Bitcoin isn't just straight up, you're going to be able to get kind of paid while you wait is what they've been calling it and talking to us about.
Putting your strategy aside, I have to ask you because this is a crypto focused podcast. Do you have any strong views on Bitcoin itself, just as an asset?
Listen, I think the asset is definitely here to stay. Once it got its institutional, approval by the SEC around 8 months ago to launch the spot Bitcoin ETPs, I think that gave just investors a lot more mainstream access to it. And so, certainly now post election, you're seeing a very pro crypto administration that's very supportive of growing digital assets. Obviously, talking about national stockpiles, other things. So to not think that it's here to stay, or not to think that longer term this is going to have continued support, and now more what I would say institutional and not just the very pro crypto and forward thinking investors that took action early. It's now able to be held in your Schwab accounts and your Fidelity accounts, which gives a much wider adoption and I think a much bigger base of people holding Bitcoin and being supportive to the growth of digital assets being here to stay and being a emerging, but starting to transition from an emerging asset class into something that's more mainstream.
Before I let you go here, Garrett, I'm sure you've seen this wave of crypto related ETF filings recently and really over the past several months. And there are a number of options based strategies out there. I've said I think we're going to see all flavors of options based crypto ETF strategies, right? I mean, cover call strategies, buffer ETFs, tail risk ETFs. We could go on and on. We're going to see all of them. Is this a space you could see NEOS further expanding into? Or, was Bitcoin in particular just attractive because, again, of the volatility profile? Just how might you think about the crypto options-based strategy space moving forward?
Yeah, listen, I think as ETF issuers has always done, as there's been an adoption or a new market structure, approved from a regulatory standpoint, what else can you do? How do you offer investors more, pun intended, optionality so that they can build their portfolios and achieve what might fit their risk tolerance or income needs or, growth and exposure? Definitely seeing NEOS, I think, adding into the space. We're seeing it, as we just talked about, morph into a more mainstream asset class. And for us, NEOS stands for Next Evolution Option Strategies. It's all we do. We don't jump from one hot product or trend to the next. We're really focusing on making sure that as investors think about their entire asset allocation, we're giving them the tools to be able to deliver what fits best for each underlying investor, whether that be, from a high income generation, from a more moderate with some risk mitigation to it. And I think Bitcoin is just another addition. So as we see the space continue to grow, we certainly want to make sure that we're still our solutions provider, offering out different products for them to espouse their views and their risk tolerances or portfolio needs.
As long as I've been covering the ETF space, I still learn something new every day. I had no idea that that's what NEOS stood for, Next Evolution Option Strategy. I love that. And again, I really find it interesting just covering this intersection of traditional finance and decentralized finance. You obviously have a product here. Really good to discuss this today. Best of luck with BTCI moving forward and really the entire NEOS ETF lineup. Thank you for joining me, Garrett.
Thanks for having me today, Dane. I appreciated it.
That was Garrett Paolella, co-founder and managing partner at NEOS Investments. Hope everyone enjoyed this episode of Crypto Prime. Please leave a review or give us a like wherever you're listening or watching. That obviously helps other people find the show. So certainly appreciate the support, and I'll see you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.